Hey everyone, welcome back. This is your old friend from Wealth Daily, and today we're going to break down the hottest, most explosive topic in the US market. Right now, from the most rational and most in-depth angle. You'll find anywhere online, institutional warning, 2026 is the biggest market risk. SOXX SMH outlook updated, ORCL the lifeline. And Nike, did the rebound already die out? Now, this is not a click, bait stock, picking headline. It's a headline packed with institutional emotion, structural signals, valuation panic, and a massive shift in market psychology. Here's what I want to do for you today. Not only will I tell you how these assets might move next, I want to rebuild the way you think about market risks and opportunities over the next 612 months. Because maybe you're thinking markets look like they could crack any minute. Is the tech bubble finally ready to burst? Should I still hold semiconductor ETFs? Are Oracle and Nike lifelines or toxic bags? If that's you, don't go anywhere. This episode doesn't just explain each stock, it links them together into one big macro chain. And let me start with a promise. By the time you finish watching this, you'll know why institutions think 2026 could be the riskiest year in recent memory, what the latest SOXX SMH positioning means, why some people are calling Oracle a lifeline, and whether that's nonsense, whether Nike's rebound is dead or just green, deeding sideways, and how AI valuation resets, geopolitics, and fundamentals are forming the real macro theme going forward. Let's hit the core question. Why are so many people calling 2026 the highest risk year for US equities? This isn't social media panic. There's real institutional data behind it. A recent global asset manager survey shows nearly 80% of institutional investors expect a correction in 2026. Most forecast a 20% pullback, and about 20% think we could drop more than 20%. This isn't one brokerage throwing darts. This is the consensus view from managers overseeing $29 trillion in assets. Risk from qualitative to quantitative institutions break it down into three buckets. Valuation, risk加 bubble anxiety. The biggest fear today isn't trade wars, it's not COVID. It's AI and the tech valuation bubble. Over half of global portfolio managers called AI driven valuations the single biggest risk for 2026. Translation markets are no longer trading on earnings. They're trading on storytelling. When price is based on imagination, not cash flow, the day imagination weakens, the losses become real. That's why semis and AI names are now ground zero for a valuation reset. Macro fundamentals are messy. Valuation isn't the only problem. Geopolitical risk is at the top of the list, especially China tension, inflation, and labor remain wildcards. This isn't just GDP slowing, it's lower growth, higher risk premiums. At the same time, structural market risk. Here's the institutional nightmare. Indexes are overloaded on one theme. Hot money is chasing the same handful of stocks. Passive flows amplify concentration. Risk volatility is silently building up. That means investors without a defensive plan could feel pain at the tail end of a bull market. And those who only buy the index and sit still face the most danger. That's why you hear institutions say passive alone is not enough in a high valuation risk cycle. Index only is no longer a safe strategy. Which brings us to the stars of this conversation. SOXX and SMH2, semiconductor ETFs, similar theme, different behavior. SOXX spreads risk across broader large, cap semis, SMH is more concentrated. Think Nvidia heavy, higher beta, bigger swings. So SOXX 等于 industry level exposure. SMH 等于 high octane growth exposure. And here's the institutional read through. Volatility expectations are rising, meaning semis may react faster and harder than the index. AI bubble fears are intensifying, and semiconductors are the first order derivative of AI capex. If AI hardware demand slows or even flattens, what happens? SOXX and SMH get hit first. That's why the correction probability for 2026 looks so high. Semiconductors are now the market's most exposed risk proxy. Now let's talk about that punchline. ORCL is the lifeline. That phrase carries two messages. The market is hunting for an exit ramp Oracle. Might look like a safe pivot. Recent trading shows ORCL popping. Pre-gen market and headlines suggest deeper US enterprise expansion and new AI infrastructure deals. So YouTubers and commentators start screaming, ORCL 等于 structural opportunity 加 downside hedge. But here's the mature take. Some analysts are now saying Oracle is basically leveraging its balance sheet to bet on OpenAI's future, which means if AI infrastructure monetizes properly, Oracle becomes a growth engine. If not, the leverage turns into a drag. So yeah, it could be a lifeline. It could also be a leveraged gamble. That's the real tension. Now let's hit Nike. Enki rebound is done. More grinding ahead. Pre-gen market headlines were brutal. Nike dropped over 10% on weak growth, especially in Greater China. Two takeaways. Consumer gen recovery trades are more fragile than tech. Nike's valuation has drifted away from its real earnings power. So the technical community reads it like this. Nike's rebound was a technical repair, not a fundamental turnaround. Part 1 takeaway. Here's the logic chain we've built so far. Institutional risk expectations are rising sharply into 2026 AI valuation and tech concentration are the core anxiety. Semis, SOXX SMH carry the front. Gen-loaded risk ORCL could be a hedge or a leveraged gap. Nike's bounce is structural weakness, not strength, and that points to one core conclusion. The market is heading toward high volatility, fragmentation, and valuation reset, not a linear melt up. So next, we get practical. How do you position against 2026 risk? What's the ETF and single gen stock playbook? How do institutions defend when volatility spikes? Stay tuned for part 2, coming up next. If you're already learning something, smash that like button and save this video. Alright, let's keep going. You now understand where the risk is, where the bubble lives, and which players are fragile. Now, here's the real question. When the market gets squeezed by high volatility, high valuations, and weak macro, how do you survive? And I'm going to say something cold but honest. In the next face Shabami once, making money in US, stocks won't be about courage, it'll be about structure. If your strategy is still all in on tech's big caps only, indexes never loses, then 2026 is about to deliver a very expensive reality check. 3 rules of survival rule. Fei winners won't be the highest gen beta gamblers. They'll be the ones who control tempo. Rule Fei R. Semiconductors still run, but they turn into trading vehicles, not religion. Rule Fei San. Real gains require companies with real cash, gen flow improvement. Understand these 3. You're already ahead of 80% of retail investors. The 2024 playbook is dead back then. Just buy tech and sit. But now, valuation cost is real, interest, gen rate cost is real, risk premium is real, narratives used to dominate. Now, capital allocation decisions decide survival. So what's defense line 1? Cash flow is king. For a decade, we fell in love with future stories. We worshipped TAM, we worshipped vision, we worshipped CEOs selling dreams. But today we ask one brutal question. Can your cash flow survive long enough for your dream to pay out? If the answer is no, your valuation is fiction. Next, volatility must enter your decision model, not just returns. Ask, how volatile is the name? Does it defend well on the way down? Does it buy back shares during stagnation? Does it pay dividends? Does management execute? That's called risk gen adjusted return. It's not about how much it goes up, it's about how little it kills you. Now, SOXX SMH. Here's the blunt truth. They remain the engine of market upside, but they're not close. Gen your, gen I's, gen N, gen get, gen rich anymore. Why? Semis today aren't cheap. They're priced on future growth. Where does that growth come from? AI infrastructure, AI PCS data, gen center build out cloud, capex chip demand. If corporates cut capex, semis stall. If data gen center growth slows, semis shift from growth model, fei inventory, gen rebuild model. Inventory rebuild means short rebounds, no structural upside timing, not conviction. So the playbook is buy dips, not breakouts, trim strength, reload when liquidity panics. Semiconductors are spiral cycles, not straight lines. They rise on over gen optimism. They fall on over gen panic. So the alpha moves are make money inside volatility. Don't become a believer at the top. Offense time. Why is cash flow king? Because all valuations eventually get priced back to cash flow. Look at companies institutions are adding to. They share three traits: real cash gen flow growth, not expectations, steady buybacks turning volatility into cash dividends, or capital return reducing investor stress. That's why names like Oracle, Nike, and Legacy Blue Gen chips are getting attention. Not because they moonshot, but because they stabilize investor psychology. 震荡 markets test one thing: not courage, patience. If a stock doesn't moon but buys back shares every quarter and pays you dividends, guess what? Even if the market drops 10%, you're still intact. That's real risk management. In the next cycle, it's not about who gains fastest, it's about who loses slowest. High gen volatility markets weaponize emotion. You panic. Buy the top, you panic. Sell the bottom and the stocks that cause the worst behavior. No cash flow, no dividends, no buybacks, no valuation anchor. That's why people are calling Oracle a lifeline. Not because it skyrockets, but because it provides emotional seatbelts. It won't CX you, but it can keep you alive when semis whipsaw. Nike, on the other hand, cash flow isn't bad, but the growth narrative broke. When narrative breaks and cash gen flow support is weak, markets get shaky. That's the problem for all consumer names. No consumer confidence, 等于 no valuation expansion. Here's the maturity test, true investors. Ask only, what's my risk budget? How much can I lose? How is my capital allocated? What's for beta? What's for safety? What's for locked? JM profits. If you can't answer those, you're not an investor, you're a gambler. The future market isn't about risking your life. It's about structuring your portfolio. Get the structure right, and you don't need adrenaline. Get it wrong, and courage won't save you. 5 Gen sentence survival code. Here's my entire attack gen and gen defense code in 5 lines. Cash flow is king. Dreams aren't assets. Semis are trades, not religion. Volatility, 非 valuation. Tempo, 非 courage. Buybacks 等于 body armor. Dividends 等于 immunity. Long 减 term rewards. Patience, short 减 term, kills impulse. Now comes the tactical section: portfolio construction capital. Temperature zones 70%, defense 减 first allocation cash. Gold short 减 term bonds sectors worth stalking into 2026. That's coming up in part 3. Get ready.